Balancing risk with reward is an evolving challenge throughout any investment journey. The universe of funds to invest in, however, provides smart options to help you get the best of a combination of asset classes. Hybrid funds, for instance, have their portfolios typically structured with a mix of equity linked instruments and fixed income securities, which helps you gain a measured exposure to both equity and debt asset classes, and in some cases, even to gold and international equity markets. Depending on the appetite for aggressive or conservative return, each hybrid fund is unique with its mix of investments targeted at different types of investors. For those looking to enter the world of mutual funds, this balanced approach appears to be a good way to test the waters and generate income in the short run while achieving wealth appreciation in the long run. If you would like to understand more about hybrid funds, you have made the right choice by tuning in to this special presentation from Mint. I'm your host Gautam Srinivasan, and joining me in this conversation are Swarup Mohanty, CEO of Mirae Asset Investment Managers India Private Limited, and Vineet Nanda, founder of Sift Capital, which is a financial advisory and wealth management company, and co-founder at Globalise, which deals in international financial investments. Gentlemen, it's great to have you come in and provide your expertise on the topic. Swarup, let's start with you. Hybrid funds witnessed a net inflow of over 27,000 crore rupees in the June quarter recently. Now that's double the figure from the previous quarter. Now, as markets remain at elevated levels, which attract many new or first-time investors, why is the value proposition of hybrid funds a good fit right now?
One thing is, in that 27,000 crores amongst the hybrid category is the arbitrage fund category, which has provided a fair amount of that 27,000 crores that you are talking about. But clearly, the hybrid fund, contrary to the way we would want it, comes into vogue when markets are at a typical high or markets are at a low when investors are a little confused. They tend to come towards hybrid funds, which necessarily should not be. And hence, this is a very typical sort of psyche of flows which we have seen in the past, and it's getting repeated now. Predicting markets never work out, but typically, when markets enter a new sort of zone, both on the upward side as well as the lower side, there are the two sides of hybrids which come up. When at a peak, you have the aggressive hybrid getting flows. When at a bottom, you will have the balanced advantage fund sort of getting flows, and that is how it works. But typically, when you look at the category of hybrid funds across, these are very strong funds with fundamentally very strong investment processes. And if you cut down the hybrid categories, which we will in the next few minutes, you will see that each category stands on its own merit, on its overall horizon of investments. So I would really like to see a continuous flow into hybrid funds over this cyclical flows is my opinion.
All right. So as we swing from one end to the other, a lot of folks think that hybrid funds is at least a good starting point. But Vineet, coming to you, looking at the overall portfolio of an investor, how can hybrid funds bring in a much needed balance in your opinion?
Well, see, hybrid funds, because it's a vast category, play different roles for different investors with different risk appetite. So let's say for a very conservative investor, who probably is a more debt-oriented investor, but who wants to take baby steps into equities, can essentially start, let's say, with the debt-oriented hybrid category, where they take small exposure to equity to basically test their experience with equities. And because in debt-oriented hybrid fund category, the volatility is much lesser than probably a category which is having more equity, it gives them a good entry point to test their experience. At the same time, from a very long-term perspective, for people who want, a more low volatile kind of experience or less volatile experience, then the balance advantage category can give them an ability to participate in the equity markets, but in a manner where the equity component of their holding is getting more dynamically balanced per se.
All right. But overall, looking at it, do they make a good fit in the market that we are currently?
Well, it will always have its relevance. As Swarup mentioned, that we should not look at the hybrid category purely in certain market conditions. I think one has to look them more from the asset allocation and the risk appetite for the investor. and they should have essentially a role to play in all market conditions.
Absolutely. Common sense is always the best sense there is when it comes to markets. Swarup, if we could understand the investor profile better, typically what kind of investors should opt in for hybrid funds? What would you say to that?
I think Vineet laid that down perfectly. Investors who are more debt oriented in the risk profile can look at the lower end of the risk spectrum in the hybrid categories, which is the equity savings fund and probably the balanced advantage fund. But people who are well versed with equity and would like to step it a little higher can come to the aggressive hybrid part, because the aggressive hybrid part has a defined equity and debt portion, and both can play out over a period of time. So it is catering the overall category. And if you want to park your money for a short time, the arbitrage is there obviously for you. But depending on the risk profile, what the overall category offers you are products suiting all kinds of investors. But one must really look at the portfolio of the aggressive. One caveat which I'd like to leave behind, because when you're looking at, say, a low risk person aiming at an aggressive hybrid portfolio, one should look at whether that portfolio is more tuned towards the large cap or the mid cap. If the aggressive hybrid portfolio is tuned towards the mid cap, then the risk profile should be accordingly suited to the fund by the respective advisor or the distributor.
So in that process, any myths that you'd like to break when it comes to hybrid funds, just for that, for the new investors who are watching out there, what their assumption about hybrid funds is, some of the myths that are associated with hybrid funds, anything you'd like to clarify on that point?
The only myth is that, when you invest, you'd like to catch the upward cycle of the market, and that's when the true potential of the asset class plays out. And in that, you have to be very clear of each category of hybrid funds. And if you're not very conversant with catching the upside of equity, then you should reverse or revisit your own risk profile before even venturing into investing at all.
All right. Vineet, let's expand your initial comments. Broadly, there are 6 categories within the hybrid fund segment as per a SEBI classification. Now, all of them offer a rather differentiated investment proposition, as you mentioned, from aggressive, conservative, and balanced to balanced advantage, multi-asset, and arbitrage. So how should investors, especially those who are new, decide which is the right type of hybrid fund product for them in the context of the mix of debt and equity linked instruments in them? If you could expand on your answer to give more details to all the new investors watching out there.
So I think we can start category by category. So arbitrage is basically purely a parking instrument. So anyone who has money available, let's say from 3 months to, let's say, 6 to 9 months, compared to putting money, let's say, into a short-term FD or even a liquid fund, arbitrage provides a much more tax-efficient, parking vehicle per se. For people who want to conservatively park money, but their horizon, let's say, is not 3 years, and hence they don't want to go to the debt category, can look at the equity saving category, because that provides a 25% roughly equity exposure along with equity taxation. So that means after 12 months, you are able to get a long-term capital gains efficiency on it. And then, for people who are comfortable with greater equity allocation, one can look at the balanced advantage fund category, where the equity component typically, when the markets are high, will be between 30 to 40%. And that equity component can increase to 65 to 70% when markets are low. So basically in that, the equity component is more dynamically balanced, and therefore it is less volatile compared to a pure play balanced fund, which will typically maintain a constant, 70 to 80% kind of a equity component. Now, for people who want to have debt, equity, and potentially have gold or other assets, there, the multi-asset fund essentially will take care of taking exposure to all asset classes at the same time and still have a bit of dynamism in terms of balancing of the different asset classes within the fund.
All right. You spoke about tax efficiency of arbitrage funds. If you could expand on that, how are hybrid funds and their subtypes positioned just from a tax perspective?
Sure. So typically, whether your money is lying in a bank or a bank deposit or in a pure liquid fund, your taxation is marginal rate of taxation when you keep money for the short term. Whereas in an arbitrage, though in terms of the nature, it's a pure debt-oriented fund, but it has equity taxation, which means that you are liable for 15% short-term capital gains tax. So for people who are in the 30 to 40% tax bracket, there is a big tax arbitrage which is available to people. And in terms of the returns are similar. So let's say in today's environment, the gross return on arbitrage funds are roughly in the region of around 4.5%. So basically, an investor is able to make a post-tax return of roughly 4%, even when one is keeping money any time from 1 month to, let's say, a 6-month horizon, which compared to any other alternative is much more tax efficient and return efficient.
All right. And staying with that theme of tax efficiency, Swarup, if I could come to tell us more about, say, the equity savings fund category, which gets a lot of attention, especially for the advantage it provides when it comes to taxation.
Yeah, Gautam, I think you nailed it, because, when you're looking at investors over the period of years and you look at financial planning over the past, a lot of the financial plans are very linear in nature, and they've already been assigned a certain returns. And with the falling returns in the debt side, one can only stick to those previous returns by adding a little bit of risk. So the equity savings provides that fantastic upside with equity exposure between 20 and 40%. And if that 20 and 40% is managed in a relatively sane manner, a lot can happen to that debt investor is what I've been observing over a period of time. So add to that the arbitrage part adds to the whole thing and gives it an equity taxation. So post-tax returns of this category becomes quite attractive over, say, the erstwhile debt projection of returns. And that said, if you keep the debt side aside, it's a good step up for an investor to enter into the nuances of equity and to understand the volatility of equity, and to understand that in volatility always lies the opportunity, and then graduate upwards in the risk meter. So it solves a lot of purpose, and it's a good category for investors taking steps into equity.
All right. Now, if there's opportunity in volatility, swings are in the nature of the market. So what do you think, if there is a significant market correction, how do you think that will impact investor interest in hybrid funds? If you could expand on your initial answer, how do you think if a correction happens, what will happen? Would it be a good time to invest in them?
Gautam, I'll come back to your previous question on the myth of this, that, typically investors follow their investments as per markets, but markets can never be controlled. If they were just to concentrate on an asset allocation, like Vineet said, a lot can be done. You cannot predict markets, and all you can predict. The question is not where the market will go. Question is what you will do if the market goes a certain way, because you can only control yourself, not the market. So if the investor were to concentrate on his or her asset allocation, and whether that sort of changes as per the markets and the reaction is on that, which we call a review and a rebalance, a lot can happen to wealth creation. Watching markets and reacting to them never lead to wealth creation.
It's like watching a cricket match. You can be happy or you can be angry, but your emotion doesn't materially impact the match.
Absolutely. If markets correct, what would typically happen is the debt part will go up because of the valuations of equity coming in. Then the distributor or the advisor would come in and say, is this the time to rebalance or not? And that is what you can action. You cannot action the market. So
understood.
Concentrate on your own behavior rather than the market behavior.
All right. Vineet, for a lot of the investors who are watching this conversation, what would be some pointers that you give them in terms of having a conversation around hybrid funds with their financial planners? What would you suggest to them? What are some of the points they should touch upon?
I think the first thing is that a lot of people try and focus on the environment, as you said, looking at the markets. And I think one thing that COVID should teach everyone is that you can't control the environment. So if you focus on what's in your control, that is the way you will have success. Now, from an investor perspective, what's in his control? First thing is knowing his financial goals and therefore knowing the time horizon of his investments. Second is knowing their volatility appetite. And I would not even use the word risk appetite, because honestly, if you have the right time horizon and you're investing through the mutual fund route, I don't think there is any risk to capital that you really have. It's about the volatility that you have to be willing to bear with. And within that, than being in the right quality funds. So therefore, I think the point is that we tend to focus a lot on the environment, which we can't control. But if an investor, along with the help of his advisor, is able to focus on elements within their control, they will be able to have far greater success. Because, this is a journey where in the end of the journey, there is definite success. It's only how do you complete the journey is the challenge. And
Absolutely.
that journey will never be straight line. It will have volatility. And therefore, if you're able to focus on the fundamentals, you will have much more success rather than really trying to control the environment.
All right. And Swarup, for the DIY kind of investors who say don't have a financial planner, what would you suggest to them in terms of what to look when gauging the quality of a hybrid fund? Because there is a variety, plus within say a particular category there will be many options. So when they look at a hybrid fund, how should they gauge its quality? What's your view on that?
I think the first thing the DIY investor should know that no particular single fund can offer asset allocation to the investor if he or she is invested in multiple funds. For one single fund to offer an asset allocation solution, then that person has to invest in that one fund, and that one fund has to be the total investment universe of that person for relying on that one fund to form his or her asset allocation. That's one thing which a DIY investor should know at a fundamental stage. The second one, I think, is the risk profiling, which is a gradual process. Some of us who thought we knew our risk profile would have gone through a huge process during the COVID time, and the markets fall 40%. Thankfully, some of us saw it the second time because some of us went through the 2008 crash. And I think knowing one's risk profile is very important. And once you know that, and as Vineet said, you have to invest with a goal. If you don't know why you are investing, you will never know where to invest.
Understood.
Right? Find out why you are investing. Once you know why you are investing, you will probably come to know that you may or may not need a hybrid fund. So for a DIY investor, that is primary. First, find out why, you set your goals, and then finding a solution is not the bigger issue. Solutions much later. But the purpose of investing is more important. Then within the risk profile, if you feel this is the returns that are possible, one can sort of gauge the returns that are possible. Then one should then look at coming to a particular category. But the other part is more important than selecting of the funds for a DIY investor. And that's where, we always say that an advisor or a distributor plays a huge role, because defining that why is a very critical role, and assessing the risk profile an external person can do much better than you yourself. These are bigger roles.
All right, Vineet, if I could bring you in to expand on this point, typically financial planners associate investment with goals. So where does hybrid fund fit in when it comes to, being associated with goals? What's the time horizon folks look at when they look at, making it part of their portfolio in service of their goals?
Typically what happens is that when you have a certain goal, and then within that you will have a certain asset allocation which the person is comfortable with, based on the risk profile. Now, based on the risk profile, assuming there is a certain debt equity mix which is required, then the advantage of hybrid funds is that you can introduce debt in the portfolio of the investor, but still create tax efficiency. So in a pure debt fund, you have to wait 3 years for the investment to become long-term in nature, and then you have indexation benefit. Whereas in many of the hybrid categories, because your long-term becomes after 12 months itself, so you have tax efficiency available. So I think the different hybrid products essentially have a different mix of debt and equity. And therefore, depending upon the asset allocation which the investor has, one has to pick up the relevant hybrid funds based on, one, the time horizon of the money. Because where the time horizon is lower, there then you look at things like equity savings or arbitrage, and you look at the balance advantage of the balance category where the time horizon is longer and where the debt allocation needs to be relatively lower compared to, let's say, the arbitrage or the equity saving category. So I think the time horizon and the amount of debt which the investor wants in the portfolio will determine which is the relevant hybrid category for the investor.
All right. On that topic of time horizon, Swarup, is the appeal of hybrid funds different for those who are, say, early in the game versus, say, those who are late into the game? How does the appeal of hybrid funds differ in terms of an investor portfolio who's, say, a millennial, whether it's 23, 24, starting out, versus, say, someone who's late into the investment games around 45 or around 40 and wants to get into the investment game?
Yeah, somebody who would be older would have to necessarily invest more in a growth asset than somebody who is earlier. But having said that, the risk profile is more determining the factor than the age in this category. Somebody who's little lesser prone to risks would want to come to the hybrid category. But the aggressive hybrid is anyway 75 to 80% invested in equity. So it's already almost an equity fund. So the merits of an aggressive hybrid fund is separate. So while the rest of them can be viewed on the risk part, but when you look at the aggressive hybrid in particular, and that is more or less an equity fund is how I would classify it.
All right. Vineet, do you recommend SWP in hybrid funds to your investors, and how does it help in their portfolio? If you could give us some use cases here.
So first thing is that SWP typically is a requirement of an investor who wants regular income, right? And I think the other precondition typically for people is that the regular income should be coming only from the returns and not from the principal of the investments. Now, when you try and do an SWP from a hybrid fund, the big risk that you run is that obviously hybrid has some equity allocation. And when markets will be volatile, which they will definitely be in the journey, you will have a situation where then you will be dipping into the principal to create that SWP. So my submission or my suggestion is that one should look at SWP only from a pure debt category, because there is enough tax efficiency available in SWP from a pure debt fund, and we should avoid doing SWP from any hybrid fund. So though some people may be attracted towards it because of probably better returns compared to a pure hybrid category, but one should be cognizant of the risks which come when one wants to go for an SWP from a hybrid fund. And I'll give you a short example. Let's say if we go back to March 2020, we had a scenario where not only the equity markets went down, but the bond yields went up. So technically you had like a negative return both on your equity part and the debt part. Now, if you're running an SWP, you are definitely kind of redeeming more units to meet your regular requirements. And I don't think that's a healthy kind of long-term play to create.
All right, we're almost out of time. So Swarup, let me conclude by asking you, static asset allocation versus dynamic asset allocation, your preference, and why do you believe so?
We are big fans of static asset allocation because at the end of the day, you get a plan to invest in, and remaining invested always brings out the best of the asset class. Typically, people feel when markets correct, invariably the opportunities are not there. But when you look at markets from a correction perspective, at all corrections, there are opportunities beyond the set of stocks that we are looking at, say, a particular index. If you look at the situation just before COVID, when the market was very polarized to a few stocks, there was the rest of the market completely open at a value stage for the fund managers. So the market is far broader than what we see. So being invested always has its own values. And especially from an aggressive hybrid perspective, which is a typical example of static investment, what I'd like to bring to the fore is, the equity part and the debt part, because of their being static invested, have their own plans in place. They get their horizons, they get their play in both asset classes. But when you come to the dynamic asset allocation, the debt part typically follows the equity side. So the debt is never able to settle down in a long-term horizon or contribute. If you look at the aggressive hybrid, what it does is it's a 75-25 mostly sort of thing, where the 75% plays out in the long run, and the 25% of debt, because of it being static, also contributes to the overall returns over a period of time because of the interest rate cycles. And then just one caveat to the static allocation, it has to be followed by a good review and a rebalance. When you look at some of the returns that come from the aggressive hybrid, a lot of it is also attributed to the rebalance, which happens invariably over a yearly basis, and it brings it back to that 75-25 sort of mode, and that gives you that additional kicker over returns because of the play of both the assets.
All right. On that note, it's time to wrap up this discussion on what make hybrid funds tick for investors. I'd like to thank both Swarup and Vineet for sharing with us their insights on the topic. And of course, thank you to our viewers for tuning in. This is Gautam Srinivasan signing off.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.